Hello and welcome to the Commodities Institute podcast. I'm Emily Costa. Today is January 20th, 2026. And as always, we're going to slow things down and really dig into what the latest developments in global commodity markets are telling us about where trade, energy, and raw materials are headed next. Let me start by saying this has been one of those weeks where the stories taken individually may seem sector specific, but when you step back, they paint a remarkably coherent picture. This is a market being reshaped by government policy, by geopolitics, and by a growing willingness among major players to use commodities as leverage. I want to begin in China, because nearly every major commodity story this week somehow connects back there. China's fuel oil imports fell sharply last year, dropping to about 21.6 million metric tons. That is roughly 376,000 barrels per day, and it represents a decline of more than 10% from the record levels seen the year before. On the surface, that looks like a demand story, but in reality, it is much more about policy. Independent Chinese refiners have long relied on fuel oil as an alternative feedstock when crude import quotas run short. In early 2025, higher import taxes and thinner consumption tax rebates changed that equation. Fuel oil simply became less attractive. Refiners responded rationally, pulling back purchases and prioritizing crude whenever possible. Looking ahead into this year, analysts expect that behavior to continue unless crude supplies tighten or specific heavy grades, like those from Venezuela, are disrupted. What makes this more interesting is what China is doing at the same time on the export side. While fuel oil imports fell, China's exports of marine fuels surged. Exports of low-sulfur bunker fuel rose more than 11%, pushing total volumes to over 20 million tons. Zhoushan, China's rapidly expanding bunker hub, has now overtaken Fujairah in the United Arab Emirates to become the world's third largest ship refueling center. That tells us something important. China is not stepping back from energy markets. It is repositioning itself further downstream, capturing value in shipping and logistics, even as upstream demand shifts. From oil products, I want to move into geopolitics and upstream energy, specifically Syria. This is one of those stories that could quietly reshape regional energy dynamics. Shell has formally asked to exit Syria's Al Omar oil field, the country's largest. The field recently came back under government control after nearly a decade of being held by Kurdish forces. Shell suspended operations there back in 2011 due to sanctions and the outbreak of war. So this move is not entirely surprising. What is surprising is the level of interest now coming from United States firms. ConocoPhillips has already signed an agreement to develop Syrian gas fields, and Chevron and others have expressed interest as well. The Syrian oil minister says the Al Omar field once produced 50,000 barrels per day, but is currently producing closer to 5,000 due to years of underinvestment and damage. Syria's total oil output today is under 100,000 barrels per day, a fraction of pre-war levels. If even part of that capacity is restored, it could shift regional supply dynamics, especially for neighboring energy-starved economies. Staying with energy, but moving east again, India and the United Arab Emirates have signed a $3 billion liquefied natural gas deal. Under this agreement, ANOC Gas will supply 500,000 metric tons of LNG per year to India for 10 years. That makes India the UAE's largest LNG customer and reinforces how Asia continues to anchor global gas demand. This deal is not just commercial. It is tied to broader trade ambitions and even defense cooperation, highlighting how energy security and geopolitics are increasingly intertwined. At the same time, European utility ENGIE is doubling down on renewables in the Middle East. It has reached financial close on a 1.5 gigawatt solar park in Abu Dhabi, its largest solar project globally. With renewables momentum slowing in the United States and Europe, the Gulf's abundant land, sunshine, and fast-growing power demand are becoming impossible to ignore. For ENGIE and many others, the Middle East is no longer just about hydrocarbons. It is central to the energy transition. Now let's turn to agriculture, where China again sits at the center of the story. A single cargo of Canadian canola may not sound dramatic, but context matters. This is the first Canadian canola shipment to China since imports were halted in October due to steep anti-dumping duties. That halt effectively brought China's canola crushing industry to a standstill for the first time in at least a decade. Inventories were drawn down to zero. Crushers simply ran out of feedstock. The resumption of imports, even in a limited way, signals that tariffs are likely coming down sharply, potentially to around 15% from more than 80%. That is a massive shift. It immediately boosts prospects for Canadian farmers and undercuts Australian exporters who had hoped to fill the gap. Futures markets responded quickly, with rapeseed meal prices falling to multi-year lows on expectations of renewed supply. Soybeans tell a similar but broader story. The United States lost significant market share in China last year, falling to about 15%. Brazil now dominates, with nearly 3/4 of China's imports, and Argentina has also gained ground. This was driven in part by trade tensions that halted US shipments for months. Although trade has resumed and China is expected to meet its purchase commitments, the damage to US market share is real. Once supply chains shift, they are slow to snap back. From crops, let's move into metals, where China's influence is even more pronounced. BHP reported record iron ore production in the first half of its fiscal year, yet it also acknowledged accepting lower prices during negotiations with China's state buyer. That is a significant admission. China is using its centralized buying power to extract concessions, reshaping pricing dynamics in the world's most important steelmaking input. At the same time, BHP is grappling with rising costs at its massive Jansen potash project in Canada, with estimates now up to $8.4 billion. This underscores a broader trend. New supply across many commodities is becoming more expensive and more complex to bring online. Rare earths provide another lens into strategic trade. China's exports of rare earth magnets to Japan fell in December following diplomatic tensions and new export restrictions. Shipments to the United States also declined on the year, even though some controls were temporarily paused. Rare earths are no longer just industrial inputs. They are geopolitical tools, and buyers are responding by stockpiling whenever possible. Finally, let's touch on dry freight and soft commodities. Russian wheat prices have risen due to limited Black Sea supply and bad weather at ports. Export estimates for January have been cut, and while crops have so far been protected by snow cover, the risk of frost damage remains. Meanwhile, Brazil's coffee exports delivered a striking contrast. Volumes fell sharply, but soaring prices pushed export revenues to a record $15.6 billion. Higher prices more than compensated for lower shipments, a reminder that value matters just as much as volume. As we wrap up, the common thread across all of these stories is leverage. Whether it is China shaping trade through tariffs and quotas, producers using scale to influence prices, or governments tying energy deals to diplomacy, commodities are being used strategically. For traders, policymakers, and investors, understanding these linkages is more important than ever. That's it for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.